People ask me about bank statement loans all the time, and I get why, because there's a lot of confusion around them. A lot of people hear the phrase bank statement loan and they immediately think it's some kind of shortcut or loophole or that it's risky or not legitimate. The truth is it's none of those things. It's just a different way of documenting income. The traditional mortgage world has been built around W-2 income and tax returns. That works great if you're salaried or if your income is very clean or consistent on paper, but the reality is a lot of people don't fit neatly into that box. Business owners, self-employed borrowers, people who write off expenses, people with variable income, they can make very good money and still not look great on a tax return. That's where the bank statement loans come in. Instead of using tax returns to calculate income, these loans look at your actual cash flow. They review your bank statements, usually 12 months, sometimes 24 months, and they average out the deposits to determine qualifying income. So the focus shifts from what you report on a tax form to what actually flows into your accounts, right? Now that doesn't mean it's a free-for-all. There are rules, there are guidelines, there are underwriters involved. Deposits still need to make sense. Lenders are looking for consistency. They want to see that the income is business-related, recurring, and sustainable. Large one-time deposits still get questioned. Transfers between accounts still get backed out. It's not a shortcut, it's just a different lens. One thing I always explain to people is that bank statement loans reward organization. Your finances are clean, if your accounts are separated properly, if your deposits are easy to trace, these loans can work really well. If everything is mixed together and messy, it becomes harder, right? Not impossible, but just harder. Another big misconception is that bank statement loans are only for people who can't qualify for anything else. That's not true. A lot of borrowers who qualify for traditional loans still choose bank statement programs because they make more sense for how they operate financially. Especially for business owners who don't want to, change how they file taxes just to fit, a lending box. Rates are usually a little higher than conventional loans. That's the trade-off. You're getting flexibility on income documentation, however, and that flexibility comes with a cost. But for many people, the math still works. The payment makes sense, the deal makes sense, and that's really what matters. Down payments are typically higher as well. You're usually looking at, minimum 10%, but to get a decent term, 20%. So anywhere between 10 and 20% is what most people that are putting down that are using these bank statement products. Obviously, it depends on credit, property type, overall strength of the file. Again, that's part of the risk equation from a lender's perspective. Credit matters still. Like, there aren't no credit loans. Strong credit options, well, there are hard money loans to some degree, but strong credit opens more doors, better pricing, more program options. Lower credit doesn't necessarily kill the deal, but it does tighten the box. Another thing that people don't realize is that bank statement loans can be used for purchases and refinances, like primary homes, second homes, even some investment scenarios depending on the lender. They're not just a one-use product, they're versatile when structured correctly. What really matters with these loans is upfront conversation, understanding how income flows, how accounts are set up, how deposits show up, what the goal actually is. That's where most people go wrong. They jump straight to numbers without talking through structure first. And I'll say this too, bank statement loans are not a last resort. They're a planning tool. When used intentionally, they can be incredibly effective. When used blindly, they can feel a little frustrating. But the difference is guidance. At the end of the day, lending is about telling a story that makes sense on paper. Bank statement loans just tell that story using deposits instead of tax forms. Same goal, different method. If you understand that going in, then everything else gets a lot clearer.